لا هلا شوي بكير بس بشار قريني بده يعمل recording.
All right,
Bashar, give me a sign. We're on? Okay, perfect. So, hello everyone. Good evening, everyone. My name is Isa Abu Daye. I'm MA Jordan's president. With us today, Vice President is with us, Sireen Shaheen, if I'm not mistaken, and others. On behalf of everyone, we'd like to welcome you to our March event, Investing for All Ages. We are very excited for many, many reasons. First, to have Bashar Amad and Sami Nabulsi, which are two really prominent professionals in the field of investment in Jordan, who will be sharing with us today some of their experiences. The second reason why we're very excited is because it is a timely topic, and we're all here to really think during COVID days how to go around with investment, with making some money, or with getting the financial story running for our lives. And the third is that we have had one of the biggest number of signups from abroad. Around probably 60 people from outside MAA Jordan signed up on the system. Some of them, unfortunately, never end up being there, but the number of people signing up is increasing, which is lovely because that really puts us in contact with all of the other members of MAAs around the world and allow us to get to know them and share our expertise with them. Without further ado, I welcome you all, and I hand on to Mr. Iyas Shuaibi, who will be the moderator for this session.
Theme song.
Hi everyone. I thought that this could be a good introduction for our talk today, talking about investing for all ages. My name is Iyas Shuaibi. I have a Master of Engineering, graduation of 90 class of 98. I'm a strategy consultant with a focus on energy and mining. I can claim I'm very good at looking at projects from $100 million up to $1 billion. However, I wasn't as fortunate with managing my own money. Since my early start, I relied on myself with picking stocks, looking at Forex exchanges and stuff like that. I did good and I did bad, and I think I did more bad than good. So I wouldn't do it. I would always go to the experts when it's time to come for managing my money. And I'm very pleased to present two colleagues and friends of mine, Bashar Amad and Sami Nabulsi. They don't only bring a strong financial expertise and certified chartered accountants, but also they have hands-on expertise of managing wealth from smaller amounts to much bigger amounts. Bashar Amad has 25 years of experience in brokerage, private equity, funds, portfolio management, and sits on the board. He's a board director on a number of establishments, including Jordan Dubai Islamic Bank, First Insurance, Wood Industries, so you name it. He's been there, seen that. The same thing goes for Sami Nabulsi. He's also a CFA and a well-seasoned investor who's handled positions with capital investments and sits on the board of more than 10 representations. So I want to give the floor to my colleagues to share with us some basic principles that takes into consideration the, let's say, the average investor, but they will cover also the needs of the more affluent and more demanding one. They're going to share with us approaches to investment, why invest, and talking about stories and what's happening right now with the news that we hear every day about Bitcoin, about GameSpot, and all of these things. I won't take much of your time, but before I hand it to my colleagues, the guideline, the only guideline, because we have around 30 attendees, is if you have questions, and I'm sure you have questions, please indicate so in the chat message below, so we can pay attention to that. And you are, you have your order in line to ask questions. The presentation, as I understood, is around 20 to 30 minutes, and then we'll have 40 minutes for a question. Thank you so much, and I hand it over to you, Bashar.
Thank you, Yas, for the lovely introduction. Just a quick, we are both CFA charter holders, me and Sami, and we're not chartered accountants, but CFA charter holders, which is more of the financial certificate rather than accounting certificate. And exactly as Yas said, when we were asked to do this presentation, we struggled, Sami and I, with how detailed and how deep can we go, and we always thought of the mentality of we're approaching people who are similarly from the same industry as we are, and then we were more aware of the fact that we are actually talking to a very diverse audience. So what we are gonna go through, we're gonna go through basic principles that we believe everyone should actually adhere to whenever they think about investing. This might sound a bit simple for the seasoned investor among the audience, but we wanted to approach everyone in the beginning. And if any of you would like to go into more details and more technicals and more complicated questions, we are more than happy to actually dive deeper into any of those subjects that you would like us to talk to you about. So just to quickly start, I'm going to share my screen with you. So the screen is clear and visible to everyone?
Yes, perfect.
Okay. Just one sec. Okay, sorry. Okay. I'm just having just a little bit of trouble with this. Okay. So, oh, okay. You can see the quote now from Warren Buffett. I just want to make sure I'm flipping the pages right.
Yes, it's on.
Okay, excellent. So during the presentation, while going through it, my take on it, I tried to quote the best investor that actually lived and still living among us, which I believe is Warren Buffett. And the reason being is this is the single investor that was able to perform above the market year after year after year for the past maybe 50 years by now. And the first quote is, you don't need to be a rocket scientist. Investing is not a game where the guy with the IQ of 160 beats the guy with the IQ of 130. Investing is very intimidating to a lot of people. And whenever the thought of buying stocks and looking at stock markets and watching the indices and what happened and why stocks are going up and why stocks are going down, it's very intimidating to a lot of people. And it shouldn't be. Investing, when you approach it in the right way, is actually a very simple and straightforward exercise. And it's an exercise that we believe every single person should engage in. And that's basically the message that we're trying to drive through all throughout this presentation. The first question that pops into mind is, why should I invest? Sami and I are in the business and we are cursed by being in this field. So why should somebody like Dr. Isa bother with this and not focus only on his practice? And the reason is very simple. We have these two charts in front of us. The chart that is on the right is the USD purchasing power over the past 50 years. This is what $100 in 1971 could have bought you in terms of purchasing power compared to what it can buy you today in 2021, 50 years down the road. You can see that $100 has dropped more than 80% in its purchasing power value. So having cash and just sitting on cash is a losing proposition on its own, because as time passes, the value of money will drop. Whereas on the left side, we look at the S&P 500 over the same period. And you can see the massive increase that happened all throughout these years and what your investment in the S&P could have done over the same period of time. The main idea of investing is you need to preserve the value of the money that you have and you need to save for your future. The only way to do that is through investing. If we take a simple example and just assume that we invested $1,000 in 2011 in a selection of stocks. I started with the most obvious. Had you invested $1,000 in Amazon in 2011, you would have had $18,290 today. This translates into 1,729% rate of return, which is a 33.75 annual rate of return. Similarly, if you look at Apple, it would be $1,000 would be $12,000 by now, and you would have achieved 28.5% rate of return every year. These are the obvious stocks, and anyone who's ever passed in front of a CNN or Bloomberg TV or whatever would have told you, yeah, I know these stocks have done really, really well over the past years. But what I did is I went into a kind of a different type of investments. Had you invested in Nike, your investment of $1,000 would have reached $8,000 in 10 years. Had you invested in Boeing, and given all that happened with the aviation industry, with the COVID-19 and the turmoil that went through the aviation industry, whether aviation makers or operators, with all of that turmoil, your $1,000 would have netted $3,897 in 10 years, which is a 14.5% return year on year. Let's go to a more boring type of investment, Procter Gamble, a company that we use its products every single day, a house staple item. And an investment of $1,000 in 2011 would have netted you $2,777. I went to even an extreme scenario, which is SCI. SCI is a funeral service company. They have funeral houses across the US and Canada, and they basically take care of funerals. That investment, which is the most morbid and boring kind of investment, would have netted you $5,000 on your $1,000 investment, which is equivalent to 18.3%. The market overall, had you just decided not to think of where to invest and just bought the index of S&P 500, which is composed of the top 500 companies in the United States, you would have netted 11% year on year. Had you invested in gold, your return would have been 1.9. Had you invested in cash, your return would have been probably a mere 2 to 3% over the past 10 years with all the fluctuations that happened in the interest rates. That table is here to show you what investment does if you look for the long-term investment. If you keep your money in the market and if you keep adding to your investments in the market, this is the kind of returns that you will be achieving over a 10-year period. And this is not only for the American market. If you look at the chart on the right, this actually is similar in the Japanese market, in the German market, and in the French market, and so on. All of these markets did well. Of course, none did as well as the US market, and it is the biggest market in the world, but that is similar in other countries as well. Now, when we talk about investments, there are so many ways that you can invest. And for people who know the markets, this would be very simple, but for people who are new to this, you can invest in stocks, which is the very basic way of going into the market. You go on and buy Microsoft, buy Amazon, buy Boeing, and what have you. And this is the most common way of investing. For people who are not that eager to take risk and do not have the heart for market fluctuations and seeing their investment go up 50% and then go down 50%, bonds are the other way of investment. Bonds is simply a kind of security that gives you interest rate twice a year for a certain period of time. They are not risk-free, but they are definitely less risky and not for the faint of heart. And as we go on, Sami will actually approach this from the time in your life where you should be investing in your stocks and time in your life cycle when you should be investing in bonds. The third and easier way of investing are funds, be it mutual funds or exchange traded funds. And these are available today for every person to access. Rather than you studying the market, looking at stocks, deciding whether it's time to buy Amazon or it's time to buy Microsoft, you can allocate your money to a mutual fund. That mutual fund is managed by professionals such as Sami and myself, and that mutual fund will invest in stocks based on what the fund manager believes is the best investment. And the investor in the fund will reap the benefits of that. Similarly, the same approach can be done in real estate. You can invest in real estate through funds, and you can just place $5,000, $10,000, and be actually a part investor in a real estate that generates rent and can generate regular yield for you on your investment. Now, the title of this presentation, which was, I have to give the credit to Sami, Investing for Life, it has actually the meaning of you have to invest for your lifetime, and you can invest, investing for all ages, sorry, that's the title, and you can invest at any point in time, regardless of what stage of life you are in. The main point is you have to invest. And the main points that you need to have to keep in your mind whenever you're investing is, and this is also Warren Buffett quote, you do not invest what you have left after you had spent your money. You spend what you have left after you have invested. The key point is, if you want to invest and if you want to do this properly, if you make $1,000 by the end of the month, you take $100, you invest the $100, and you spend the $900. If you keep this as a strategy, then you will have that fabulous returns that we looked at the beginning of the presentation. And you have to always distinguish between investing and trading. When you talk about investing, investing is investing for the long run. It's not investing to buy a car in 6 months' time. It's not investing so I can make $10,000 and go on vacation. This is trading and not investing. And with trading, you will go through the experience that Iyas probably mentioned at the beginning. You will make a lot of money and you will lose a lot of money. When you invest, and looking 8 years back at the US market, if you invest and keep on adding to your investments, and if you have the heart to withstand market turmoils, you will achieve a positive return on your investment at the end. As we said, the S&P 500 netted 10%, 11% year after year over the past 10 years. And if you go back 8 years since the beginning of the S&P index, you will find the same results. A lot of people come to us and they ask, is it a good time to buy? When should I go into the market? Buy in October, because in October the market is always going down and this is a good time to buy. All of these are speculations. None of them stood the test of time. There is no proper time to go into the market. Trying to time the market is a futile exercise by all means. What you should do is you should invest in a regular manner. This way, you can invest sometimes when the market is at the bottom. Sometimes you will invest when the market is at the peak. But you will average a good entry point over the long horizon of your investments. Markets are always volatile. If you look at any market in the short run, and anyone who has looked at the market during the past year, 2020, would have seen what volatility means. We were having an up market up till March, COVID hit in, market dropped a massive, massive percentage, and then the market recovered and even exceeded where it stood before the COVID crash. Markets are very volatile. If you want to invest for the short term, you will have to suffer the market volatility. And the one thing that also a lot of people need to focus on is, whenever you want to invest, try and invest in something that you understand. Investing is like buying a car. When you buy a car, you look at the model, you study the car, durability. When you actually own the car, you have to understand, where is the engine? How do you change the oil? If there is an error message, what does it mean? This is the way you have to approach investments. Invest in what you understand. If you are a doctor, invest in companies that you understand and are related to your field. Not necessarily pharmaceuticals. You can invest in a tech company that actually does the CRM software that you are using in your clinic. It doesn't have to be something that is purely into your business, but it has to be something that you understand. I remember a very famous quote for Warren Buffett when the tech bubble in 2000 occurred. Before the tech bubble actually burst, everybody was investing in technology that very, very few people understood. And Warren Buffett wasn't. And people asked him, why aren't you investing in the dot-coms? And he said, I don't understand it. And I don't invest in something that I don't understand. This actually played very well for Warren Buffett when the bubble burst. If you invest in what you understand, you will be able to make a rational investment, and you will be able to exit that investment at the proper time, or keep that investment if you still believe in it. And the final thing, which is a very cliche, but it couldn't be more true when it comes to investing, is don't put your eggs in one basket. Never go in and say, oh, I like Tesla. I heard that Tesla is going up. Today, a famous fund manager called Cathy Wood made a prediction that Tesla will hit 3,000 in 2025. Please do not go and put all your money in Tesla. Because if that prediction came out to be incorrect, you're out on the street. Always diversify. Buy 20, 30 stocks. Put your money in over a very diverse kind of investment portfolio. Some of them will lose, some of them will win. But overall, you will fare very well. I've taken probably enough time for now. I would like to move to Sami to go slightly more into the life cycle of a human being and how does that affect your investment decision.
Thank you, Bashar. And I don't want to reiterate what you've mentioned, but definitely, and you have to look at different asset classes depending on your investment objective and the life cycle you are currently in. So why invest in equities? As Bashar mentioned, it has superior returns, it has a probability of long-term growth, but also it has a very high volatility, and it's not predictable. For example, if you wanted to jump on the hype of GameStop and it reached around $480 in end of January, and you bought at the 400, 2 weeks later you've lost 90% of your investment. So basically, you have to understand that every asset class has its pros and cons. Fixed income, less risky, gives you that fixed income, fixed coupon every 6 months. But at the end of the day, they don't have that growth element. And over the past 120 years, the long-term real rates of return of equities always exceed bonds. And the third main asset class is alternative investments, as briefly mentioned by Bashar, which includes real estate, commodities, hedge funds, and private equity. So private equity is investing in private businesses. These are traditionally more risky. They're more liquid, long-term in nature, and they lack the sources of information that you find. So basically, with all of these asset classes, the key here is diversification. And the more you diversify your portfolio, the better risk-adjusted return you achieve. So investing in a whole it's a lifelong process. The first part of a successful lifelong investment strategy is to have a disciplined approach, a diversified approach. This discipline also goes back to savings. Once you have to have a regular contribution to your savings or your investment account in general. And if you can automate then that would be great. For example, when I started working and when I got children, every month there was an automatic deduction from my account to my children's accounts. And this is the way, even if it's a small amount, over years and over months, these become a large amount. And speaking of children, you need to start introducing the art of saving into your children early on. All of their birthday gifts, their monetary birthday gifts, their holiday-related gifts, even reward them for making certain chores by reading a book or washing your car. It is very important for them to save, and for them, if they want to buy something, for example, my son wants to buy the PS5, he needs to put aside some money to buy that money, to buy that PS5, and to feel the value of his money going out to buy something rather than keeping it aside in his bank account to invest. So savings start from you and your children. So every investment has to have a proper investment objective. This could be either simple or very complex. And the investment objectives of every investor, it boils down to specific goals, to the life cycle where you're in, and to special circumstances whereby you wanted to invest in a Sharia compliant manner or a humanitarian manner or whatever belief you have in mind. So when we say specific goals, there are several ways of identifying an investment objective. It has to be specific, has to be quantified, it has to be comprehensive, it has to have a relevant time horizon, it has to be actionable. For example, an investment objective, if your 2-year-old son, you want him to go to McGill when he turns 18, that is a specific investment objective. Your time horizon is 16 years. You're not going to be required to make any payment from now to 16 years until the tuition is due. In 16 years, in 2037, the tuition of McGill is not going to be the same tuition as of McGill in 2021. So you have to factor in some inflation, some growth in the tuition for the next 16 years. And set aside every year from now to 16 years an amount to cover that tuition and to invest it in a certain rate of return to achieve between contributions and return on your investment to reach the tuition levels that you have in mind for your son. So that is one part of it, which is specific goals of an investment objective. Going into a life cycle approach, you have basically three phases. The first phase we want to talk about is the accumulation phase. So the accumulation phase, usually this is a more of a time where investment goals are Bashar, if you want to go to the other slide, it is usually shorter term. It's more specific. You want to pay down your debt. If you're in the 20s, you graduated from McGill, you wanted to start a life where you want to get married, you want to have children, you want to save for a home, you want to provide for education for your children, and then you want to put some money aside for investment. So this is called the accumulation phase. This is where you accumulate some of your savings, and here is the rate of your savings is more important than the rate of your return. The goal here is to save part of your cash flow by saving, let's say 15 to 20%, to achieve your specific short-term goals until you reach to the second phase, which we call it a conservation phase. This phase is your peak earning years. It's in your 40s or 50s. It's where basically the investors tend to become more conservative financially. They're more concerned about having their money to serve them more in their retirement years. Bashar, the second slide or third slide is on the distribution phase. In the distribution phase, this is where the focus is shift to using your own money that you have accumulated in the accumulation and conservation phase to provide you during your retirement phase. So basically, during your accumulation years, the goal is to turn your cash flow into your net worth, while in the distribution years, this shifts into turning your net worth into cash flow to serve you in the years that you're not working on. So basically, which phase are you in? It's all influenced by your age. As we said, early years, usually it's the accumulation phase. Your marital status, usually single people have less financial burden in terms of kids and education and what have you. It also what applies to it, dependents are your parents depending on you to support them, and your financial position. Some people just graduate from school, but they have a family business. So the accumulation phase is no longer applies to them, given that they are automatically within the family business and they have the wealth is already there. So these are the typical phases that a person goes through across time. The allocation of the portfolios, basically depending on your phase, depending on your investment objective, depending on your time horizon, and also depending on your risk averseness. Usually young people are more risk averse. They usually can take more risk in terms of having their small savings to grow in a faster pace. In this regards, your asset allocation is more prone towards equities. The more risk averse you become, the more income you need. This shifts more and more towards fixed income investments, whereby you want to conserve the investments that you have, and you just need that income that to be paid on a semi-annual basis. Now, if you want to go into themes, and I'm not going to go into specific stocks and what have you, I have some selected themes, investment themes that it's worth mentioning and it's worth exploring more from your end. We see there's a shift towards renewable energy. There's a shift towards Europe, specifically with the high returns in the US markets for the past year since March. There's the return. So many fund managers and so many investors made so much money over the past year. They feel that the US market, let's say the crazy returns in the US market that we've seen, is going to become more and more selective and more opportunistic. And that's why we see a lot of fund managers are shifting their capital into the European equity markets, which have relatively underperformed the US market. So the rotation here is going into long depressed European equities and specifically financial institutions such as banks, because banks are a key factor in any recovery of any economy. And this is going to be true also for the European economy as a whole in general, if we're talking about holistically. And it also means that the stance on euro will be a bit bullish going long term from here. Another interesting sector is the semiconductor sector and the impact of the pandemic and the impact of demand and what happens on the semiconductor. As we know, most products and most things that we use today in our life, they have a computer chip on it, and that computer chip, we call it semiconductor. There was a massive shortage of computer chip across over the past year, which affected many industries. For example, the auto industry. Last month, Ford announced that it will slow down the production of its flagship, its very highly profitable F-150 pickup trucks. That automatically would reduce their production, production forecast in the first quarter by 10 to 20%. Ultimately, they see that the shortage of this very small semiconductor chip will impact Ford by $1 to $2.5 billion in their earnings. So why did this happen? Why is there a major shortage in semiconductors? It's two main reasons. One main reason is the pandemic. As millions of people are forced to work from home and learn from home, rather than spending their money on movie tickets and vacations and what have you, they're spending their money on electronics, on new laptops, new screens, new game consoles, as they're spending more time at home. All of that put a huge demand on electronic companies to buy all the extra semiconductor chips. All of this created a vacuum in other industries, such as the auto industry, that has not only Ford, VW, Nissan, Toyota, all of them have suffered from shortage of semiconductor chips across in the past year. Also, the shift to 5G technology, which basically is deemed to be the growth driver for the semiconductors. And as you all know, 5G is the new mainstream. It is 10 times. It has 10 times faster data rates and 1,000 more data traffic. And all of this will require more semiconductor chips going forward. So as the demand for 5G technology increases, and by the way, last year alone, 1/4 of the phones sold in 2020, a quarter of them are 5G ready. So there was a huge, there is and there will be continue to be a huge demand of semiconductor chips in the future. So who's paying the price? It's us. It's us as consumers. We end up paying higher prices for electronic products that you used to pay them at lower prices. We need to wait a few months until the launch of an iPhone to get our hands on. My son is waiting. It's been 5-6 months since the launch of PS5, and he cannot get one at the market rate, which is, now if you want to get it in the black market, is double and triple the price of the announced price of a PS5. So all of this, as us as consumers, we are paying the price of this shortage of semiconductor chips. So why not chip companies make more chips. It's not as easy as that. It takes billions of dollars and takes a couple of years to establish a highly controllable environment to manufacture some semiconductor chips. So I don't want to go into details on this, but I just want to show you that a small thing can affect many industries across the world, and the demand will continue as people come more online. A vaccine will roll out more, economies will open more, cars will become more in demand, and as we see, geopolitics between the US and China will continue to affect this supply chain. Many of the semiconductor companies, like the Taiwan manufacturing company, went up by 40–50% over the past 6 months. Lam Research went up by 60% over the 6 months. All of them are showing that how do we establish what is an investment theme? We see what is a shortage, where is the demand, and what is the future. And for us, this theme specifically is the future, and many of the semiconductor companies would reap the benefit of this industry or trend. A lot of you are asking about Bitcoin and cryptocurrencies in general. Me personally, I don't have much knowledge about Bitcoin in very specific ways, but as a technology, as blockchain technology, we know that this is going to be the future. Banks as an intermediaries will become less and less reliant upon as this technology become mainstream. And since Bitcoin is the first cryptocurrency, it reaped the benefit of the hype and took advantage of it. In general, as simple math, as someone who doesn't know very well about Bitcoin, I believe the future Bitcoin is strong. I would be long Bitcoin as it's becoming now the new permanent term trillion-dollar asset class. In Bitcoin's past 12 years history, there hasn't been a supply shock that has been evident over the past few months. 16% of all the Bitcoins available has found their way into new wallets at the price range of $46,000 to $58,000. So basically, you're creating a floor. You're creating a floor of $1 trillion asset class, which will only, I believe, go up from here. And it's in simple math. Only 2% of the world population have invested or have exposure to Bitcoin. And there's only going to be 20 million Bitcoins available in the world. 90% has already been in supply and circulation. A chunk has been lost forever. I think around 4 million Bitcoins have been lost forever. So there's only a limited amount of supply. And with the amount of millionaires and billionaires coming online, there will be, I guess, more demand on Bitcoin and cryptocurrencies in general. Do I say if you have $100,000, put it all in Bitcoin? No. It is back to all diversification. Maybe you want to put 2–3% of your portfolio, but never follow a hype of Bitcoin or GameStop or whatever for the sake of making quick gains. If you want me to make quick gains, put your money in a casino and on a roulette table and get hope for a 32 times your money. Other than that, it is not a casino. You have to have a discipline. It's a lifelong process. And the last thing we're going to talk about, a lot of people are asking about gold and silver. If you read the investment reports, like JP Morgan, a lot of them are saying, and they're pessimistic about gold. They say that the gold price will go down to $1,550 this year, maybe to another couple of $100 next year. This is driven by higher US yields and basically the view of a less haven stock or asset as economies are rolling out vaccines more and opening up faster. So people have more comfort on the economic growth of the global economies. So they are more scared than the drive they drove Bitcoin, the gold from 1,200 or 1,400 in March of 2020 up to 2000. So they feel more confident about the economies coming up or opening up, and that is putting a bit less demand on gold. I personally believe that gold will have its run up. We believe that as gold miners is a better hedge on gold, or better bet on gold as gold miners, given their operating leverage, especially those with strong balance sheets, they are more prone to take advantage of any upward trend in gold. Silver, although it's a more of a speculative commodity, it has formed an upward trend recently if we're talking about pure technicals, and it has a more favorable silver to gold ratio. So it's also on an uptrend to go up. Last but not least, for those of you who are planning to send their children to Canada to study or have investments in Canada or have expenses in Canada, I've read a lot that the Canadian dollar appears to establish a bottom pattern. As my days back in '98 to 2002, there was a bottoming pattern that had been forming, and it only went up from 2002, 2003 upwards. We see that the same pattern is being formed right now, and there's a general uptrend that has been forecasted for the Canadian dollar. So that's about it. Sorry for taking much time, but just to have a more practical on the themes that are going forward. And it is up to you to do more research and to go to your financial advisor to ask for more details on which stocks will reap the benefits of these themes. Back to you, Bashar.
Thank you, Sami. Just to wrap up some of the discussion points that we had initially set out to relate to you. This is another quote by Warren Buffett: "Is you can't produce a baby in 1 month by getting 9 women pregnant." When you approach investments, the way you approach investments has to be forward-looking, and it cannot be something that is short-term and something that has to be done in a quick manner. I'll give you examples of what happened previously in the markets and how people can commit really fatal mistakes when they have short-sightedness in the market. Short-term thinking is one of the most common mistakes that anyone can make whenever they're investing. In this chart, we have just one sec. Let me just remove this. This is the chart of Amazon over the past probably 10 years. And short-term thinking is, let's look at, this is the price of Amazon when we reached the COVID-19, just before the COVID-19. There was this sharp drop in the price. And people who are invested in Amazon, if you understand the business, if you are a user of Amazon, if you invested in Amazon after you saw this huge potential, having this massive drop because of a market panic shouldn't drive you into selling and getting out of your investment. Nothing changed in the merit of Amazon. As a matter of fact, with the COVID, their business actually increased. If you sold immediately after that panic, you would have foregone a huge upside potential for your investment. People who stayed in the investment and did not panic reap the rewards of this. The second common mistake is the herd mentality. And GameStop, which I don't know if most of you heard of what happened in GameStop, but this chart that is on the right shows you what happened in GameStop during the past few months. GameStop was a company that had a dying business model, and people decided, because a lot of hedge funds had shorted that stock, they actually believed the stock should go further down, so they shorted the stock, and just people decided, let's go in, let's buy GameStop, and let's break Wall Street. The price skyrocketed to $430, and then what happened? Reality kicked in, and the price dropped back again. Now we still have that swings happening, but GameStop was trading at $200 yesterday. Imagine if you were the person who bought at $433. You wouldn't be a very happy person today. And believe me, if you buy today at 200, you will not be a happy person tomorrow. The herd mentality is what drove the price up, and that doesn't have any lasting effect whatsoever. So do not follow the herd. Do not buy a stock just because everybody else is buying it. allowing emotions to drive decisions. This is also a very common mistake. What you should do is when you invest regardless of emotions. You invest because you believe in this investment. And this graph below for Google shows that, this is the third graph, shows that on 2 occasions, Google dropped massively, dropped a good 40–50% on both occasions, and then the price continued to go up. If you had let your emotions control your investment decision making at that time, you would have forgone a huge opportunity, and you probably would have lost money. If you believe in the concept of your investment, and if your investment merits did not change, you should remain in your investment. As a matter of fact, whenever something like this happens, it's an opportunity for you to double down and increase your investment in that company that you believe in. The fourth and most common mistake is diversification. And as I said, a lot of people would go in thinking, NEO is going up, I will buy NEO and sit on it. That is a really bad and risky investment strategy. Diversification is the key point for anyone who wants to go into investing. And the last, and in my opinion, the deadliest mistake of all, investing borrowed money. Never, ever borrow money to invest. This is not investing, this is speculation and trading. Because of market volatility, and because the only way to come up as a winner in a market is to stay for the long term, you cannot be borrowing money to invest. If you borrow money to invest, there will be a time, markets will drop, people who lent you the money, brokers basically, will ask for their money back. And that's when you realize your loss and you exit the market and you lose even your principal that you had invested in the beginning. Never invest borrowed money, invest your own money. The issue of investing in what you understand and investing in what you see around you is actually much simpler than it sounds. If I'll give just very quick examples. If you go back 4 years from now, when every other car in the streets of Jordan was a Nissan Leaf or a BMW, the electric i3, I think, that was a sign for anyone on the street. Electric cars are the future. You don't need to be a financial guru to realize that there is a major shift towards that. Invest in electric cars. If you were a parent like myself and back 10 years from now, each trip when we traveled, the first stop that we make for my kids was GameStop. The trip would not be complete without stopping at GameStop. So we would go to GameStop, that's the first location we go to, and we buy games. 4 or 5 years down the road.
Sorry to interrupt you, but we are running a little bit more than the time allocated.
I'll wrap up in 2 minutes.
Yes, thanks.
So 4 or 5 years back, I used to go and travel and ask my kids, don't you want to go to GameStop? And they would look at me and say, you know that look that says, Dad, you're such a dinosaur? Because nobody bought games from GameStop anymore. They're loading it from PlayStation. That's actually when GameStop started to go down. When you look around you, when you analyze the world around you, you will start seeing the themes that Sami was talking about. You will start seeing how 5G is coming into play, how cryptocurrency is coming into play, and you will realize more and more how to direct your money and where to invest. This is basically, I will wrap it up here and I will open the floor to questions. I will end with one simple quote. Those who do not learn history are doomed to repeat it. And please look at the history, learn from it, so you will not fall into the mistakes again.
Excellent. Thank you, Bashar and Sami, for a wealth of information. Investing is for all ages. It can start anytime with accumulation, conservation, and distribution. Be wary of your emotions. Do not borrow money, and don't go after the herd. With that, I think some of the lessons for myself. Thank you for that. I open the questions. Already we have a number of the questions in the chat, but also I encourage others to pose their own questions. So we have a few here. Would you like to respond to these, Bashar or Sami, if you have the screen in front of you?
Yes, just one sec. Chats. In Jordan, is it possible to set up automatic stock purchases to be deducted from someone's bank account. The models I am aware of require you to make money transfer into your investment account, which takes time and effort. And then a flat charge of $35 is charged per purchase. How to go around this to achieve smooth, constant investments? Today in Jordan, with the current providers, this is not possible. We at the end of the day, every Jordanian service provider is going through an international service provider. So we only offer what we are given by the international providers. What you are asking for is can be done. Sorry, there's some echo. Can be done through going directly to international brokers and having an account with them. The most common Ameritrade I'm aware of, and the most popular now is Robinhood. You can actually have that set in. You can have automatic investments. You can actually have even a function that reinvests your dividends. So if you're invested in IBM, IBM pays dividends 4 times a year. Every time you get $1 from IBM, that investment goes back into IBM. But with the current providers in Jordan, this is not possible. $35 is a bit steep. You can definitely get cheaper rates today if you shop around. Now, the second question is, we hear a lot of warning words about the dangers of investing in oil. It has been a very volatile market and can be easily swayed by politics. Not to mention, it will be depleted in near future. Is the oil sector where one should invest? Sami, would you like to pick that up?
Yeah, oil took its hit back in March, April, and went up significantly in terms of all of the companies that have been oil. But if I want to put my money on something, I would put it on renewable energy. There's a lot of initiatives on renewable energy from the European market, from Biden, even from China, to commit to green energy or renewable energy. So I definitely will take that bet for the long term rather than oil.
The next question is, I can't a comment about tobacco sector. Is it promising sector, or are we seeing a decline in because of the aggressive action against tobacco?
Yeah, and personally, I don't have much info on tobacco, but you see, Philip Morris is very smart in shifting its way or its technology to IQOS. So and stock reap its benefit from that. It all depends on which tobacco company and how quickly they accommodate on the regulatory and in general demand of a more healthy way of smoking. So IQOS is taking over traditional smoking in many countries, and it was smart from Philip Morris to position itself early on back then.
The next question is, I can't help but check the news and get in the action. What can I do? I'm assuming by this you mean I'm assuming that you invest for the short term and you flip your investments pretty quickly. Am I getting the gist of it right?
This is more about trading versus investing. I put some money in investments, but still, I mean, you watch the news and you can't help say, I see Bitcoin going up, and I know I'm disciplined, but still I can't help myself. I want to, go there and do something with it and capture into a trend. Some of the mistakes that you just described, actually.
Yeah, look, you have to differentiate. If you have that bug, and many people, including myself, have that bug, you have to have actually 2 portfolios. You should have an investment portfolio, which you do not touch. You establish your themes, you establish your convictions, and you watch. I want you to read the news. This is what you should do, actually, regardless of your time horizon. But alternating your investment strategy shouldn't be done unless there is a major change in the decision-making that actually you went through when you made the investment. If today you made an investment in Microsoft, you made that investment based on certain merits. If those merits did not change, do not get out of your investment. You get out of your investment when the investment that you made is no longer the company that you actually invested in. It changed massively. GameStop is a classic example. Or when the theme that you actually believed in did not materialize. For example, back to the 5G theme. If for some reason 5G did not materialize and you had invested in companies that are based on 5G technology, then that is the time to exit your investment. Otherwise, do not. So in your case, have an investment portfolio, which is a long-term, this is for the kids, this is not for you, and have a trading portfolio, which will satisfy the bug that you have. Question, as someone who never invested before, how do I start? Talk to my bank, Google a financial advisor, find an app? Probably all of the above, my answer would be. And Sami, please help me here if you have to add, if you want to add anything. But definitely don't talk to your bank, talk actually to your investment banking company, or if your bank has an investment arm, that is the arm that should help you. Google a financial advisor, definitely. You can actually go into investing.com, yahoo.com. You can go to the fool.com, the Motley Fool website. All of these, Seeking Alpha, all of these websites provide information about the market. Most of the information is free of charge. Some of the information you can pay us a very nominal amount and get access to it, something along the lines of $20 a month or $100 per year. And definitely that should be your intro into investing. Do not dive into the pool without learning how to swim first. Definitely read and read a lot and start gradually building your conviction and building what areas of investing that you feel more inclined to before you invest. For long-term investments, what do you advise to diversify the portfolio? Percentage in stocks, percentage in ETFs, in bonds, or in cash? Sami?
This goes back to life cycle and it goes back to your investment objectives. Definitely, what's more important for you? Is it growth? Are you risk averse? How much can you risk to lose? At the end of the day, ETF is always good for you in terms of if you don't have selected stocks in a certain, and you have a certain let's say favorable view about gold or about semiconductors or about a certain market in Europe, then ETF is the best way to diversify according to that theme. In terms of percentage, as I said, it all depends. If you want more income, then you want more bonds. If you want more growth, then you want more stocks and ETFs. And cash, it all depends on what your liquidity needs. So it falls down with what we discussed in the presentation.
Yeah, exactly. If you're in the beginning of your life and you can take a hit, then your weight of stocks should be higher. As you grow old and as you approach retirement and you don't have a steady income anymore, you switch to bonds and you reduce your equity exposure. So it's probably going to start as 50% in equities and 50% distributed over ETFs, bonds, and cash. And as you move in your life cycle, that shift would be 20% stocks and 80% the rest. How to choose the right mutual fund in Jordan? Okay. Being in Jordan or not in Jordan, you can access mutual funds worldwide. So location wouldn't affect the spectrum of funds that you have in front of you. How to choose a fund? This boils down to how sophisticated are you or how knowledgeable are you? If you have a certain belief that, for example, semiconductors, as Sami mentioned, is something that is hot, and I sincerely believe that this is something that I should focus on, there are mutual funds that are focused and very heavily invested in that specific sector. You can even make it simpler. You believe in China. You believe in Asia in general. You go to a mutual fund that is Asia or China based focused. If you are if you don't have any inclination whatsoever, there are global stocks funds or US stocks mutual funds that you can go into, and these provide you global exposure. They would have investments in banks in China, semiconductor manufacturers in Germany, and oil explorers in Nigeria, and what have you. So the world is your oyster. It depends if you have a certain conviction or not.
I think Nasreen has her hand up for a while. Yes.
Yes, that was the question of Nasreen actually.
Okay.
About choosing, wasn't it?
Yeah.
About choosing the right mutual fund and in Jordan.
And that's when if that's the case, yeah, then we can go to another question.
Right.
The next question is which ETF are you managing at Capital Bank? Well, in Jordan, sadly, we don't have ETFs, and the whole culture of mutual funds is very, very poor. This is due to local regulations that killed mutual funds. I was lucky to be involved in the establishment of not ETFs, but 2 mutual funds in Jordan, both shut down because of regulations that really affected the operation overall. But you can access any ETF worldwide through, be it Capital Investments, the investment company, or any other brokerage company, be it in Jordan or outside Jordan. You can access any ETF, and we're more than happy to give you our advice and our thoughts on that. What is the minimal amount that you can invest in a fund or in a bond? Well, for funds today, it can be as low as $1,000. Really, they've gone down significantly, and they are open to the average guy on the street. For bonds, usually the ticket size is a bit higher. If you are going straight into bonds, the ticket size is a minimum of $200,000. Having said that, there are mutual funds that only invest in bonds. So if you believe in bonds and you want to invest in a low risk asset, you can go into a fund that only invests in bonds, and then the minimum would be $1,000, $5,000, something along those lines. How about geographical exposure? Should I only look at the US market? Sami, you've already touched on this. If you would like to tackle this question.
Sorry, let's read the question. The question
How about geographical exposure? Should I only
no, definitely not. As we said, it's all about diversification. The US market has gone up considerably since March of 2020. I believe you should also look at other markets such as Europe and emerging markets in general. As I said, if you don't want to have selected stocks, you can follow an ETF that follows certain European markets.
Great. Salam, thank you to all the speakers. Question: what are some of the signs that a company is undervalued? Beautiful question. The way I would approach it is, if you go to any of the websites that I mentioned, most probably investing.com and yahoo.com, when you look at a company, you can look at its comparables. So if you are looking at a software development company, there are companies that are very similar to it. If you're looking at a car manufacturing company, companies that are similar to it. The website will actually highlight comparables. The easiest way is to look at the ratios of all the comparables. So if you're looking at a company that has a price of $10 and it actually generates $1 of revenue per stock, then that company has what we call a PE of 10. You look at another company, the stock price might be 100, but that company is generating $25 per stock. That PE would be 4. The lower the PE, the better. So if your company has a PE that is really low compared to the rest, it is probably undervalued. But I have to say that with a caveat. You need to look if there is a reason why this company is undervalued. The starting point is look at comparables. There are ratios like price earnings, price to book, the percentage of growth year on year. Look at the comparables. That will give you the first sign. And then look, is this company growing as good as the other companies? Is this company expanding as much as the other company? If the answer is still yes, then that probably is an undervalued company. If the answer is no, then there is a reason why this company is undervalued, because the market looking into the future believes that this company is not going anywhere.
Bashar, to add to it, since a lot of people can't calculate the PE or go into the details of financials of a company, and rely on the target of financial investment banks. Investment banks, a lot of them cover certain companies. We're talking about developed markets, and they have certain price targets for these companies. So so based on the current market value or market price of the company, you compare to the consensus target price of that company, and you see what's the upside, the potential of that company. If you don't have enough resources to study the PE and the financial ratios. But in Jordan, good luck. You need to do it on your own. I don't know if we have a consensus price target on companies.
Sadly not. Sadly not. Then we have, I think, from Kareem. Thank you guys for a great presentation. Extremely insightful and very much appreciated. You're most welcome, and we really are extremely happy, Sami and I, to be here. Then we have thanks for your presentation. Which information sources do you recommend to follow for fair and independent market, sector, and company news? As I said, I'll repeat my list because maybe I might have said it pretty quickly. And please, Sami, if you have something to add to this. My main sources that I go to are investing.com, Seeking Alpha, Fool.com, and Yahoo Finance. These are the four sources that I rely on. Sami?
I agree with you. Other than if you don't have access to paid research or research from investment banks, this is I think this is the most free way of getting your research insights.
Yeah. The next question is also, what's your view on theme ETFs versus managed mutual funds with similar focus? That's an excellent question as well. All the questions actually are excellent so far. Well, the main difference, and this is for anyone who's not really versed into the stock markets, the main difference between ETFs and mutual funds, ETFs trade exactly like stocks. So you have a price that moves up and down on a regular basis. You can buy them instantaneously. You can sell them instantaneously. It's just like a stock. Buying an ETF and buying Microsoft or buying Tesla is exactly the same. For mutual funds, it's actually a fund that has a price. This price is updated maybe daily, maybe weekly. If you want to buy or sell, you buy on weekly basis or daily basis. It doesn't have a quoted price on the market that you can see instantaneously. Now, where to invest in either, it depends on two things. Is the liquidity a very main issue and concern for you? Then ETFs are the more liquid asset class. But you need to look at the expense ratio for each one of them. These funds, whether ETFs or mutual funds, they charge a certain percentage for their management service. And that plays a role into your net return. So also you should consider which one is more expensive before you do your investment. Best way to choose an ETF. There are several that follow the same theme but are managed by different companies. How is the best way to compare and choose? Sami, would you like to weigh on this?
No, just at the end of the day, it all depends on the theme, the composition of it, and the track record of the manager. So you have to factor all of this in it. Not every ETF follow all of the themes that we mentioned, but some are more prominent than others. So as I said, it's all an expense ratio. It's a track record of the manager.
Definitely, the track record is very important. This is something really that you need to look at. And another website that would benefit ETF interested audience is ETFDB, ETF database. If you go to ETFDB, it has all the information that Sami just mentioned: historical track record, expense ratio, the top 10 holdings, and some of them even show more than that. The top 10 holdings also gives you an indication of how really focused this ETF is on the theme. So you might go into an ETF that is into electric vehicles, but when you look at the top 10 holdings, you would find that the focus is more into components rather than manufacturers. So looking at the top 10 holdings would help you in choosing the proper ETF for you. What is the best way to start if you don't have time for the learning curve required? Get a financial advisor. Hire Sami and myself.
No, it all depends on the portfolio. You know, if we're talking about a small portfolio, a financial advisor would not make sense. At the end of the day, you can open a brokerage account, and the broker can give you insights on certain selected stocks, but you need to do your own homework, because when hiring a financial advisor, you need to have a certain amount of or level of portfolio which make it more sense.
We have thank you for all the information from Ben, and thank you for the info from Lubna. You're most welcome. Are there any other questions, Iyas?
I think you've covered all the questions so far, so I think we are done for the day. I think. What do you think, Isa?
Can I have just 5 minutes just to weigh quickly on Isa? Do you have a question?
Can I voice a question at the end?
Please.
وبرضه في Helen Chan بعتت direct message to me by mistake. I think she has a question. If you can address that. My question, it's regarding strategy, really. I'm no expert. I learned my stocks from a Udemy course during lockdown in April. That's as far as I know, apart from that. But say, for example, that's what I always keep thinking about. Say you buy a stock in oil for $1, and then soon after, things get better. It's at $4 now. So you have 4 times your money. But you still think it can go up. It might become $6 or $8 or $10. In those kind of situations, would you just sleep it off and leave your money to grow, like we mentioned? Or is it too tempting an opportunity where you should just sell and buy lots more either growth stocks or undervalued stocks so that you boost your long-term profits? Thank you.
The way I would look at this is I would go back and look at the chart of Amazon. Amazon, not far back, it was trading at $100. At 1,000, you would look back and say, "Oh my God, my investment did 10 times." That would tempt anyone to sell. Today, it's trading at $3,000. It goes back to when you did your investment. What was your investment based on? And now, when you want to make your decision to sell, did that change? Is the company still following the same path? Is it actually doing better than when you looked at it the first time? When you looked at it, what was its market share? What was its growth year on year? If it's still doing the same, let your profits run along. Ride the wave. And only sell when you actually believe that this is not the investment that I looked at the first time. It is extremely difficult. And the word discipline, when Sami used it, I can't highlight discipline. This is really something that has to be disciplined in order for you to reap the best out of it. Now, one last question, and definitely everybody talked about cryptocurrency and about Bitcoin and what have you. I just need to highlight a few things, because this is a subject that, as Sami said, I'm not experienced in cryptocurrencies. I'm not invested in cryptocurrencies. And the main reason is because I don't understand it, and I don't understand anything that I don't invest in something that I don't understand. But just to cover it very quickly, I need to give you both views of cryptocurrency. First of all, I do not believe it's a currency. Currency reflects the net value and net worth of the issuing country of that currency, its growth prospects, its resources, its GDP growth, even its people, and so on. So it's not a currency per se, but people are looking at crypto and Bitcoin specifically in the following manner. When you look at gold, it's a preservation of value asset. Gold has very little use. It has some use in industries as an ornament, but has very little use. It is a pure asset that is a preservation of value. And the reason why, it's limited resource, it's not perishable like iron or copper, it doesn't need maintenance. So gold has always been viewed as a preservation of value. People who are pro Bitcoin are comparing it exactly in the same manner. It is limited resource. It is not perishable. It doesn't require maintenance. It is a store of value. And people who are projecting Bitcoin to be $300,000 and 1 million at one point are simply comparing the huge store of gold in the world to Bitcoin today. So if you look at the value of the entire gold reserve in the world today, they're comparing that to the value of Bitcoin today and saying Bitcoin has to be like gold at one point in time. Now that's one look at it. The reverse or the opposite look at it is this is an asset that has a value today that was created out of nothing. So people who are not pro Bitcoin do not believe that this is something to invest in. They believe that as Bitcoin came out, God knows, like 2,500 other cryptocurrencies came afterwards. And so that notion of limited supply is not really true. When you look at Bitcoin, exactly as Sami said, do not go and throw all your money in. There are people on both sides. Both have merit to what they say. If you want to invest in Bitcoin, invest a small amount of your portfolio. If you have $1 million for investment, probably put 5% in Bitcoin. If you have 1,000 for investment, put 5% in Bitcoin, but not more than this. I personally am not invested in Bitcoin. It's something that I do not understand, and I would rather make my money somewhere else. But if you have any concerns about your view on Bitcoin and crypto, the question actually just popped up, so I hope I answered it. Do invest, and since now there's an ETF coming out for crypto, it's a Canadian listed ETF. It's probably going to be the first one. Do that. Access to crypto, by the way, you have to be very careful of what you do. You cannot, usually you don't access cryptocurrency through a broker, just like stocks. You actually go directly to an exchange and buy. You do not go through a broker. If you want to have crypto as currency in your e-wallet, you have to go directly to an exchange. There are exchanges worldwide. There is BitOasis in the UAE, and it's only open for UAE residents and UAE people who have residency in the UAE. There is something called Swissborg. You can buy Bitcoin through Swissborg. You can buy it through Coinbase. That's if you want to buy Bitcoin and have the ability to actually transfer it from one wallet to the other. Maybe buy a car at one point, buy a Tesla with it, since Tesla will be accepting Bitcoin in the future. If you do not want to go directly through the exchange, you can go through a broker, but your Bitcoin investment will be stuck with that broker. You can only buy through that broker and sell through that broker. You will not be using your Bitcoin that you bought through that broker to send it somewhere else. This is something that anyone who's going into crypto must consider. Many of the brokers offer you crypto CFDs. So you're not actually buying Bitcoin. You're buying a contract that reflects the value of Bitcoin. It's another way to get exposure into Bitcoin, but you have to be really aware of what you're doing. Ask your broker, are you what you're buying? Are you using CFDs, contract for difference, or are you actually buying the actual asset? That was probably the last question about Bitcoin. I'm not sure if there are any other questions regarding Bitcoin or any other subject that we talked about.
Yeah, can I have just one last question, please, if you don't mind? I'm just following up to what Isa said. I mean, for example, like if you're looking at Amazon, if you're looking last year, around April, it was like around 1,900. Now, obviously, with everybody's shopping online, you're seeing the stock going up to 3,000. So in this case, if you're looking for the long-term investment, what's the best way to approach it? Would it be just ride the wave, invest now and just hold and see what happens like after 5-10 years, or to wait, see what happens like after we kind of go back to normalization in life and then make your strategy about investing? For, I mean, just an example like with Amazon, but it can apply to any other stock.
Personally, what I would do if I'm allocating $10,000 to Amazon, I would probably buy one share today, buy one share in 6 months, buy another share in another 6 months. When I'll give you a personal experience. When COVID hit and the Dow Jones Industrial Average started dropping. I looked and I thought this is a buying opportunity. At 19,000, I thought it's going to hit 15. Actually, at 25, I thought it's going to hit 19. When it hit 19, I thought it's going to hit 15. It hit 19 and shot through the roof, and now it's trading 33,000, 32,000. Timing the market will never succeed. I missed that opportunity because I was waiting for the 15,000, and I had to chase it back. What I should have done, bought at 27,000, bought at 23,000, bought at 19,000, and if it went down to 15,000, bought again at 15,000, because I believe that this is short term. This is what you should do with Amazon or any other investment that you're looking for right now. You would never know whether next year it's going to be 4,000 or 2,000. But you do know that on the long run, with the growth rates that we're seeing, with the move towards online purchasing of everything, Amazon will continue doing well, at least in the foreseen future. Any other questions?
I think that's it for today, and thank you again, and I hand it over to Isa.
Well, thank you very much. It has been truly inspiring. I mean, I'm not in the business field, and I thoroughly enjoyed it. I thought you managed to capture everyone's attention at all levels of expertise and at all age groups. Mr. Bashar Amad, Mr. Sami Nabulsi, it has been a pleasure to have you on this talk. It is a pleasure to have you as members of our chapter. Iyas Shuaibi, thank you very much for beautifully moderating the session. To all the attendees, thank you for your time, for your questions, and we'd like to remind you that our upcoming event is beginning of March with Dr. Carl Moore from McGill University.
April.
Sorry? April, yes. Sorry, it's April 2nd, if I'm not mistaken. So Dr. Carl Moore will be talking to us about introverts, extroverts, ambiverts, and how they lead. So we advertise for that in due time, and we'd love to see you there as well. Thank you very much. Once again, Bashar, Sami, Iyas, everyone, and have a good night.
Thank you. Good night.
You're most welcome. Good night.